Hello, Jim here. Today I want to talk about selling options on ETFs and how that can potentially be safer and in some cases more profitable than trading stocks. I'm also going to share with you some of my favorite ETFs that I do like to trade on. And then finally, I'm going to talk about a new strategy related to covered calls. Instead of selling covered calls, I'm looking at selling what I call a covered spread or covered vertical call spread. So stick around. I think you're going to really enjoy what I have for you. Just a few words about the market before we jump into the main topic for today. The market, with Trump winning the presidency and then the rate cut later in the week, it just hit new highs where a lot of stocks and a lot of ETFs are way up there and very, very pricey. What do I think could happen next? I would not be surprised if we get another week, maybe a couple weeks of this Trump trade, that I think is what they're calling it. We may even reach newer highs. That doesn't change, the fact that price does matter. So you do need to be careful. I'm going to be careful. I'm still buying puts for protection on the downside, and I'm actually looking at potentially buying calls on the upside too to protect me, so that if I have certain ETFs or stocks that I'm selling covered calls on, I'm going to probably look at selling what I call a covered call vertical spread. And I'm going to talk a little bit more about that in this next part of the video. But my main consensus is to stay safe. This happened back in 21 and it was very similar. We hit amazing highs, but in 22 we gave it all back. And a lot of people were kind of in a bad way. I remember I had some people in my membership that took a beating. One instance is with Wayfair. They had made some trades on Wayfair in the 300s, and Wayfair dropped all the way back down to the 30s. So my main point, be safe, pick good companies at good prices. ETFs, just be sure you're not overpaying for an ETF similar to a stock. What do I think also is going to occur with the Fed? I'm thinking the Fed may be done for this year. I'm not so sure they're going to have any more rate cuts until maybe next year, depending on what happens with the economy. And there's still a part of me that believes that there may be a pullback, and it could be a significant pullback. Any kind of bad news could really trigger this market. You can see in the graph that, we've hit new highs. We've had tiny pullbacks, but nothing a little bit more significant. I would not be surprised to see us pull back closer to 5,000 and then go to higher highs. So, that's my 2 cents, and I just wanted to share that. Let's jump into the next part of the video. Okay, this is an outline I just threw together. I actually had some bullet points and I put it through ChatGPT, and this is what ChatGPT came up with. So the very top, you'll see weekly expiration examples. These are stocks I've all traded in, and I like all of them. XLK, I recently did a video about it and had a very successful trade. XLE, I've traded it a lot. I've done vertical put credit spreads. I've done iron condors. XLF, I haven't had a trade on XLF yet. It's the financial sector ETF, and it's the only one I have not done a trade in. RSP, I have done trades on before. All of those are some of my favorites. They do not have daily expirations. They have weeklies. So for the daily expirations, I primarily trade in IWM, but a lot of people trade in SPY and QQQ. And I may look at SPY and QQQ depending on what happens with the market. I believe IWM has gotten overpricey recently. I'm going to share at the last part of this video. I'll kind of go over what a trade would look like with IWM and how I make decisions about it. So that'll be at the very end of this video. So why do I think that ETFs potentially are less risky and you can still make very good profits? I've done tons of IWM trades, mostly vertical put credit spreads. I've also done iron condors, and I've been very successful. Part of that reason is, it's got broad market exposure. The IWM is the Russell 2000, so it has a huge number of different companies, and it's very, very liquid. It's easy to trade, even dailies. You could even do zero DTEs with it. So it just makes it easier to work with, and that's true with SPY and QQQ. Lower impact for market events. Again, you don't have earnings, you don't have bad news about a particular company. The only bad news you might have is if, maybe the management team at the ETF changes, that may be a bad thing. But that's pretty rare with a lot of these ETFs. So not having earnings reports and, less information coming from the particular companies, it's definitely less risky than a stock. And you can also see that in the charting. It doesn't move anywhere near as much. It doesn't mean it doesn't move, but times it can move significantly. Like literally this week, the Russell 2000 went up quite a bit. I believe it went up maybe 5-10%, something along those lines. But the fact that it's well diversified and you don't have to deal with earnings, you typically don't get those kind of movements, but maybe once or twice a quarter, if that, maybe only once or twice a year. Now, what are my primary strategies that I like to do with safer ETFs? I can add the wheel to this too. I've actually played with the idea of doing a wheel trade with an ETF. It may be something I could still consider, but a lot of them have also gotten really pricey. So, but my main ones I like to do trades, and especially with the market where it is right now, is iron condors. I like to do low delta iron condors, like a 10 to 12 delta on both wings. Now, a lot of times, if the market's really pricey, meaning it's towards the call wing, meaning like currently with IWM or the Russell 2000, it's reached a new high and then it's gone past that. It's significantly higher. So I might take less risk on the opposite end of the spectrum, meaning the put wing, I might take less risk. So I may do a smaller spread and I may go with a lower delta. And in the past, it's typically worked out quite well. And then being that you have two wings, it's only going to go one way or the other. If you're dealing with a stock that you don't think will move or an ETF that won't move that much, and you want it to stay in a band, and you go with a lower delta and you go with a smaller spread, it really gives you the opportunity to be very successful. Now with IWM, I don't typically trade it to own it. Some of the others I would, like potentially XLE, I do want to own more of it, and I've never had any of it assigned to me either. So it's more ideal for neutral markets. But I do believe it can be, you can use it in a bull market too, depending on, you do have to manage it. So, but again, with having the wings and, you're buying the long put and you're buying the long call, you have protection. And like I said, I've done probably a dozen iron condors, probably 8 of those 10 are primarily IWM. I think a few were XLE, and I have never had IWM or XLE ever assigned to me. Actually, over the last 3 years, I think I've had one ETF called away, and that might have been SCHD like 3 years ago. Since then, I've especially on the put side, rarely have I had something assigned to me, which can be a negative because at times I miss some great opportunities potentially. The other is what I was talking about at the beginning of the video that I'm looking at doing. If you're like me and you sell a lot of covered calls on your existing holdings, a lot of those covered calls are deep in the money now. And going forward, something I talked about I guess 6 months to a year ago, is instead of doing a covered call, do a vertical call credit spread, but in addition to that, own those shares. So instead of doing a covered call, it's like a covered call spread versus, you get the drift. You're buying that you're buying that call so that you limit your, you don't limit your, or you minimize what you miss out on the upside. So here I use an example. So selling a 65 call and buying a 70 call, if the stock is at 60, you cap your upside loss while retaining some gains. If the stock rises sharply, if the stock surges to 85, the gain on the long 70 call offsets the short 65 call, limiting your missed profit to a $5 spread. So you're only missing that $5 instead of a full 20 increase, protecting against significant missed upside. When you look at a Palantir or you look at an APP or NVIDIA or any number of other stocks, they're not alone. There's several others that have gone up 40, 50, 60. I believe APP this past week went up like $60 or $70 in literally a week. So this is something I thought about doing. I wish I had started doing it earlier. But just like I like to buy the calls, in a lot of cases, or how I like to buy the long puts, in a lot of cases, the long calls can also be very, very cheap. And it's kind of a no-brainer. So if they're under $20, in some cases, when I bought the long puts, they've been outrageously cheap, $3, $4, $5, $6, sometimes $8 or $10. One thing I do like to mention to people, when you look at buying that long call, a long put, look at the strikes near it. Meaning, if you're looking at a $10 spread, then look at the 987. If you're looking at a $5 spread, look at the 4 and 3. I found instances where the next lower strike or two might be cheaper than that $5 out strike or $10 out strike. So just something to look at. It's I've been surprised to find that, but it definitely, probably 1 out of every 4 trades, it ends up being like that. So it's something I'm considering, and it does give you defined risk. So and the risk being, wow, I missed an opportunity. Again, for those of you who wanted, didn't get into Palantir or didn't get into NVIDIA at the right time, this would be an opportunity. And you're using, what you make selling the call or the covered call to pay for that long call. Long term, it could be well worth it. You could do very well. And again, it can be a capital efficient income generation. And it's not only just these big growth companies. I've had several instances like that. I've had eBay. eBay shot through the roof. I think it's gone up $15 or $20. What is it? Citigroup, just to name a few. Con Edison. A lot of the utilities have shot through the roof. So just something to keep in mind, something I'm looking at trying. Of course, in my membership, people will see that automatically because I'll talk about it as I post each trade to my membership. And if you're curious about my membership, details will be in the description with a link to easily access it. The membership, or the Discord side of the membership, is getting really active. And a lot of good communication, other people sharing their trades. And like I've said in other videos, some of my members are more advanced than I am. And probably, or not probably, some of them are making more money than me. And as always, please hit that like button. I'm trying to get the word out. I want people to understand that this is a great way to make some extra income. And you don't really have to put a lot of risk into it. You can really define how much risk you want to take. And that's why I was sharing the fact that sometimes ETFs may work better for people than stocks. So let's jump into the next part of the video where I want to kind of show you what an IWM trade would look like. So stay tuned. Let's jump into that. I've opened up IWM in Barchart. I also like Barchart as much as Seeking Alpha. It's growing on me as I use it more and more. I really like its charting. So I've got a Bollinger Band here, and you can see how the price recently has reached the top of the band. I typically like to sell puts more in the lower side of the band. So it's definitely hit new highs. So the risk is that it could drop significantly. So if you're selling puts over here and it drops majorly, you could potentially be in a bad way very quickly. But that's where you define your risk. You get out of the trade once it's profitable. And if you do something like an iron condor, you could potentially put the wings still, in a pretty nice band, like up here above 260 and maybe, 140. It would be hard to get a good one. It would probably be more like 170. But you still have the opportunity to do that. Now let's look at IWM. This is also still in Barchart. This is just the option prices. And I like to do monthly, so I would look at the next month. And then I'm doing 20 strikes. So these are the calls, and you can see here it's got the delta for the calls. And I would look at probably around a 12, 10 or 12 delta, which is one of these two. So it's for the 12 delta, it would be 260, again, right near that price I was talking about. So I would look at selling a 260 and then buying a 265 for, again, defining that risk. It would be a $5 spread, but I would bring in maybe 40, 45 cents. I could do a $10 spread where I would bring in closer to 60 or 70 cents. But that kind of depends on what you would prefer to do. Or you could start at the 265, which is an 8 delta. You'd bring in 61 cents, and then you could do a 275. So you would still bring in close to 40 cents. But could it go up that much? Could it go up to 265? It could, but it'd be unlikely. Over here, it got up to 248. If we go out for a little longer, let's go out to, well, that's 10 years. Let's see what the highest it was last time. It got up to like 245. So could it get up to 265 in 1 month? It could. Very, very unlikely, though. I mean, you're talking right about here. So in my mind, that's fairly unlikely. So I would probably go with the 260 and 265, bring in around 40, 45 cents. And then I would come down and I'd look at the put side. So here are the puts. And again, we have the delta over here. So like I mentioned earlier, the put side would be a little bit riskier. So if we did around a 10 delta, you're talking 216. So let's look at 216. Where does 216 stand? So you're talking right here. Could it get to 216? Well, that's very close. It seems like very likely it could get to 216 in 1 month. So that's where the real risk is. So if we come back to the strikes and we go with a lower delta, so maybe we go with let's say the 9 delta, which would be 214, or even lower. We could potentially do an even lower delta. Let's come up to the top and expand that a little bit so I can do 20 strikes or 50 strikes. We'll come again down to the puts. Let's do like a 8 delta. 84. So you could do a 213, and then potentially if you did a 5 on this side, you would come up to 208. So 60. So you'd only bring in about, let's see, that was the 8 delta. So you bring in about 83 cents, but then to do the 208, you'd have to pay 60. So you're talking almost 30 cents. So between the two, you're talking 80 or 90 cents. So not bad. You could potentially do more contracts, but that's what I would look at. Now, if we come back here to the Bollinger Band, so 216 would be right about here, kind of in the middle of the upper, here's the 30, or what is that, 20-day average. And we can look at that. Over here. Yeah, so it's the 20-day period. So still a little bit risky. Now, if we do get some kind of a correction and it comes back down to closer to the mean, that's where I've been primarily trading IWM. And what I typically like to get is right around $1 per contract. So, and I typically do more like a 10 or 12 deltas. So if we did just stuck with a 12 delta, it would be probably close to that amount. So yeah, 102, 103, and then we would go to 255. That's the 18 delta. So it would be this way. So you're talking 40, 50 cents. Or we took a little bit more risk. It would be, yeah, you did an 18 delta. So if it wasn't so pricey, it hadn't gone up so much last week, this would be a lot easier to make the $100. So for me, it's pointing to the fact that, and which what we're seeing here, IWM has gotten a little bit too pricey. Now, if we looked at something like XLE, it also went up 93.74, but not quite as bad as IWM. That's also the 10-year. So you're talking, the mean is around 87, the low is around 78. So we could come over here and do same thing. Look at the wings, see what we could figure. And again, we'll look at around a 10 delta. So this is 28 to 30 cents. And then if we went to a lower delta, looks like you could, yeah, it looks, I guess, was it down on Friday? But let's try a little bit of a higher delta, a 13 delta. So the numbers look a little bit weird. I don't know if these are accurate. If we went to 99, that's a 23 delta. This is 57 to 71, 18 delta. Looks like the mid and ask is 37 to 56. So you're talking 101 for a 12 or 15 delta. 10 delta is right around 103. And then if we looked at the puts, here's a 15 delta, so 40 cents, around 88. Went a little bit lower, you could do 87, so 80, 88, 87. But if you did an 88 and say an 80, yeah, you're talking you could get around 50 cents. So again, you're talking 70 or 80 cents. I've seen a lot of cases where, again, even with XLE, I've been able to make around $100, a little bit more than $100 per contract, like sometimes around 115, 110, 115 per contract. And it would typically look like this. It would be closer to an 11 delta. So it would be like an 87, 82 on the calls. This is the put side. And then on the call side, it would be, again, if you did a 12 delta, this is a 13, I might take a little bit less risk, but it's only $1, so 102. And then we'd go out. So if we went out 5, it would be 107, I believe. Yeah, 102 to 107, I believe. Yeah, so on the call side, it'd be 102 to 107, which is that look right with this? Yeah, so 102 would be like right up here, which that looks good from the Bollinger Band. And then the 80 would, I think the other one was 80, 82. Don't have the best memory. Let's go back and look at the puts at around the 12 delta, which is, again, right around here. So 87. So 87 would be a little bit more risky. Would be a little bit higher. So everything is pretty pricey right now, but you could go out in another month, and I will do that sometimes. I know the January expiration might also work. Like if we switch this to the January expiration, we might see better numbers. So if we went out to 117, 2025, and we did the same thing at 12, like a 12 delta right here, you're talking 105, you're bringing in around anywhere from 55 to, so the last was 49. The numbers are a little squirrely, probably because it's Sunday after hours. But that's 105. And then if we went 5 out, you're talking 110. So 105 to 110. And then on the put side, again at a 12 delta, right around here. So this is the 13 delta. So you're talking 85. So it was what, 105 and 85? Yeah, 105 and 85. We come back over here. So you're talking 105 would be up here. So that looks good. And then 85 would be a little bit better. Right about here, a little bit below the average. So that's how I would set those up. I would then make a trade and throw it into my trading page and typically do a limit order and see, can I get around $1, $1.10, $1.15, something along those lines per contract. And the last XLE I did, which I just did a vertical credit spread, so I just did the put side. I did 3 contracts. This is the one I just closed recently, and it was very profitable. And I think it was closer to 80 or 90. So this is another, you could, depending on how much risk you're taking, you could potentially do more contracts. I originally did 1, then 2, and then my most recent XLE again was 3 contracts. So that's what I wanted to share with you guys. Hopefully I didn't get too wordy with this, but this is the kind of stuff I do. And then I jump into the trading page and then, look at what I can, how much I can make for that particular trade and how much risk I'm taking. So let me know what you think. Is this something you do, or is this radically different from what you're doing? Leave a comment. I typically try to answer my comments within the first couple of days. And as always, thanks for taking time to watch, and I look forward to seeing you next time.